Alright, so in this video, I want to try and convince everyone why they should invest as soon as possible, basically right now if they can, or as early as possible. And in doing so, hopefully this will make you realize why it's important to get out of debt. So to do that, I'm going to run through 3 different scenarios, and I have the scenarios listed out right over here. The first scenario is, let's say that you choose to invest later in your life and you start investing at the age of 45, and let's say that we stop investing at our age of retirement, which in the US it's around 65 years old is when most people officially or say they retire. So that's about 20 years. And with that scenario of putting in $5,000 for 20 years, you've contributed a total of $100,000. And for this scenario to play out, we need to have some type of rate of return when we're talking about investments. And the rate of return that I'm going to choose is 7% because in the past, it was always told to me that the average rate of return was 7%. And this is invested in the stock market. But funny enough, looking online, it seems like the average rate of return is actually closer to 10%. So even using the 7% rate of return number is a pretty conservative guess. So either way, I am opened on this Roth IRA calculator. Don't worry about the Roth IRA part of it, but this will just help us take a look at what happens when we actually invest over time and how much the total worth of that investment will be at the retirement age. So the parameters here, it's a starting balance of $0. Annual contribution is going to be the $5,000 number that we put in. We can see that our current age is 45. We retire at 65 years old, and then our expected rate of return is 7%. So when I put in this $5,000 number here in the annual contribution, you'll see that it calculates that the total contribution is $100,000. And at retirement, the balance would be worth $219,000. So that's actually pretty impressive. It's doubled the amount of money within a 20-year span at a 7% investment rate of return. But what I want to get at, of course, is why you should invest now. And the biggest thing with investment is that time is probably the biggest factor in terms of investing. The earlier you start, the more significant your final balance will be because of compound interest. And if you don't know what compound interest is, essentially every year that your account grows, it also produces that rate of return, which is the 7% number that you see right here. But so if you had $100, after 1 year it grew by 7%. That means 7% of $100 is $7. Now for year number 2, you have $107. And so you're technically investing $107 for year number 2 with the rate of return at 7%. So it's compounding the interest that you are earning each year. But to get on with the scenario, let's change the balance to annual contribution to 2,000. You'll see that it's only 87,000 when we start at 45 years old. However, let's start it at 20 years old. And what you will see here is that this is calculating your balance will be worth $611,000. So we'll keep it simple like that. But if you notice, we only contributed $90,000 in this scenario, but yet over the course of the 45-year span, it grew to over $600,000, which is 3 times higher than scenario 1. And although we were contributing less money overall, the biggest factor that caused this to change significantly is the amount of time that you have invested. So let's take a look at scenario 3, which is putting in $5,000 over this same time. What you will see over here is that it actually grows significantly to $1.5 million. That's 45 there. Oops. Well, either way, you can clearly see that this is a significantly higher number in terms of what you will get out of it if you start as early as possible. And so the whole principle behind this is there's two main things. You've got compound interest, where your money compounds over time to help invest and grow your investments larger. But the other aspect is the time. The more time that you have in investing, the more that you will be able to grow your investment. And that's pretty much the biggest principle that I want you to take out from this, because if you don't start now, you can definitely start later, but as you see in this scenario, your money will not grow as much because it hasn't had the amount of time to grow, essentially. And so time is the biggest factor on our side in terms of any type of investment, to be quite honest. At the end of the day, the more time you put into investing in something, the better chance that it will be able to grow. And so understanding this principle of like this meager 7% of return, let's just do the example of right here. If we change this to 10%, how much would this grow? All right, so you see, it's almost like unbelievable at how much of a difference these percentages change the final balance at the end, because you saw that a 3% difference from 7% to 10% essentially more than doubled what our final balance would have been at 7%. With the 7% rate of return, we saw our portfolio, our balance grow from 1.5 million, and the moment that I changed it to 10%, it grew to almost 4 million. And you can see that the total contribution is the same amount. So I guess that's also the important aspect. Like, these are just numbers here in these particular scenarios, and when you invest, you obviously have to choose your different investments, and they will yield different rates of returns. But that's why it will be very important over time to make sure you know how to choose the correct investments. But what I want to do is I want to bring it back to actually debt now. And you have to understand that debt is kind of like the opposite of investments, where investments, you're trying to gain a positive rate of return to grow your investment. So in these situations, we saw this 7% rate of return. However, let's look at the most common form of debt that we see in this country. There are like student loans, housing loans, and those I think are relatively low percentages. Like I think right now the housing loan rates are around 3%, 4%, and student loans, I am not sure. But the other big one that a lot of people have is credit card debt. And when you look at credit card debt, the average credit card interest rate is around, it ranges from 15% to 20%. And so that's pretty freaking high. And that's why it's important to try and get out of debt as soon as possible, because let's say that if you were to allow the scenario to play out where you don't pay off your credit card debt and they're charging you this 15 to 20% interest rate, you can imagine how much money you would essentially owe over time. So, a good way to mimic credit cards using the same calculator is, let's say that we have we owe $1,000 on a credit card, and credit cards are good because then you can pay with stuff for money that you don't have now, and as long as you pay it back within the, I think, next 30 days, then you don't get charged any interest. It's where when you leave it alone to allow it to grow is where it becomes really dangerous. And so you can kind of see in this calculation right here, instead of an annual contribution, I'm just saying you owe $1,000, right? And let's say that you don't touch it for an entire 10 years. You can see at 7%, after 10 years, you would owe $1,900. But remember, the average credit card percentage is around 15 to 20%. So let's just put 17%. And you can see that you would now owe almost $5,000 from that initial $1,000 that you could have just paid them back then. Essentially, these credit card companies, their debt that you owe them is essentially an investment for them, because they are hoping and praying that you actually don't pay off your credit cards and to collect this sweet 15 to 20% interest rate. It's in their benefit, and that's why credit card companies make so much money. Either way, the main message that I want to get across is start investing now if possible. The biggest thing that you can see in all these examples is the aspect of time. The more time you have, the more beneficial that your investments can grow, and the investments grow because of this time and compound interest. So take advantage of it as soon as you can, and hopefully, because you understand these principles of time and compound interest with investments, you have a better perspective of why it is important to tackle debt, especially those with high interest rates. And with that, I will leave it here. Hope this has been helpful. Thank you.